In this segment, we're going to look at the use of standard costs in calculating labor variances. When calculating labor cost variances, we're going to use the terms rate and efficiency instead of price and quantity. Using the same diagram format we used when evaluating direct material variances, we see that over here on the left side of our diagram, we have the actual labor cost, which is the actual hours of labor used at the actual rate we paid per labor hour. Over here in the middle, we see the flexible budget, actual hours, times the standard rate that was supposed to be paid per labor hour. And finally, over here on the far right, we're seeing the total standards. Total standard hours that should have been incurred to produce the number of units produced, times the standard rate that should have been paid for the labor. The difference between the actual cost and the flexible budget is the rate variance. As you can see, the only difference in these two numbers calculation is the actual rate versus the standard rate. Both are calculated based on the number of actual hours. So we're isolating the rate here. Over here, the only difference between these two calculations is the actual hours versus standard hours used. Both calculate using the standard rate. So we are isolating the amount of labor hours used to produce the number of units. So looking at an example, our standards for direct labor. Say for each unit produced, we should use 1 hour labor and pay $16 per hour. Total standard cost per unit produced for labor cost of $16. So during May, ABC produced 3,500 units and the workers worked 3,400 hours. ABC actually paid an average of $16.50 per hour for the labors worked. Let's compute the labor rate and efficiency variances. If we take the actual hours used, 3,400 labor hours, at an actual rate paid of $16.50 per hour, we calculate our total actual labor cost. If we take our actual hours used, 3,400, times what the standard rate should have been at $16 per hour, we calculate the flexible budget amount for labor of $54,400. And finally, we calculate the total overall standard, which was for the 3,500 units produced. Standards say we should have used 1 hour. In other words, there are 3,500 hours allowed for the number of units produced at a standard rate of $16 per hour. The difference between the actual cost of $56,100 and the flexible cost of $54,400 give us a $1,700 rate variance that is unfavorable. It is unfavorable because our actual labor costs were greater than what our flexible budget says our cost should have been. Over here, the dollar amount of difference between the flexible budget and our overall standards was $1,600. That is an efficiency variance that is favorable because our standards say for producing 3,500 units, our cost should have been $56,000, but our labor costs were actually $54,400, resulting in an efficiency variance that is favorable. We want the amount of actual labor hours used to be less than what our standards say. The total cost variance for labor is $100, which is the difference between our actual labor cost and what our standards say our labor cost should have been. We broke that overall cost variance into how much of the variance is caused by the rate and how much of it is caused by the efficiency of labor used. We can see that we were very favorably using our labor. Our labor worked more efficiently. However, we ended up paying more for that labor.